So tonight we're helping you figure out which cloud stocks to double down on to weakness and which ones, well, maybe you got to cut loose some of. We know this whole group has gotten a lot cheaper over the past 6 weeks, but we need a way to distinguish between the high-quality names that have been dragged down by the rotation and the lower-quality names that never should have been up in the first place. When you make these kinds of decisions, you need to be ruthlessly logical, not emotional. I always tell you to check the emotions at the door. We're in triage mode right now, and that means we need to be as objective as possible. That's why we put together a simple screener for the software as a service stocks. We're going to run our whole cloud universe through these two filters. One is for fundamentals, and one is for valuation. Anything that passes both filters, well, then you got my blessing to buy down here after the big sell-off. Basically, we're doing a quick and dirty analysis of the cloud stocks to separate the wheat from the chaff, and this is done by real portfolio managers every single day. I want to teach you how to do it at home. It's a quick and dirty rule of thumb that Wall Street's been using to assess the enterprise software stocks for ages. You know what it's called? And I've only heard it once among our guests. It's called the Rule of 40. And it's quite simple. If you're running a software as a service company, the Rule of 40, here it is, the Rule of 40, says that your revenue growth plus your profit margin should be greater than 40%. If it's below 40, you're in trouble. Again, we're in triage mode here. We want a simple rule that tells us which of these cloud stocks need to be amputated from our portfolios. I like this Rule of 40 because it recognizes that there are two ways to win. The healthiest cloud stocks are either growing very rapidly and losing money, or their growth is slowing, but they've got increasingly strong earnings. If a company has, say, 30% revenue growth and a 20% profit margin, it passes the test. If it's got 70% revenue growth and a negative 20% profit margin, that also passes. However, if you're only growing at a 50% clip and you got a negative 15% margin, well, wait a second. That's 35% combined. It falls below our Rule of 40 threshold. Like I said, it's a quick and dirty way to look at things. But this is how venture capital firms and hedge funds and companies themselves like to assess the trade-off between growth and profitability that we talk about every night here. Now let's put it into practice. Revenue growth is straightforward. Remember, that's just the sales line. But there are a lot of ways you can measure margins, some more generous than others. Because we want to keep it simple, we're using the adjusted earnings before interest, taxes, depreciation, and amortization, or EBITDA margin. So who passes and who fails? All 7 Cloud Kings pass, mostly with flying colors. Twilio. You know, how much should we like Twilio? Twilio has the highest scores. The company's expected to grow at a 72% clip this year, further bolstered by a 10% EBITDA. So this is our winner, okay? Really terrific. Adobe comes in second with only a 24% growth rate because it's much more profitable, with a 44% EBITDA margin, reports this week. I think it could be very, very good. And that's Thursday, just so you know. Now, after the Cloud Kings, the quality really starts to drop off. Our Cloud Princes, Atlassian, Coupa Software, HubSpot, New Relic, ouch, Okta, they don't fare as well. Neither New Relic nor Okta makes the cut. Even before New Relic gave a disappointing forecast this morning, their slowing growth was a problem. Okta, on the other hand, is growing at a 41% clip, but its negative 9% EBITDA margin drags it down.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.